Investing without risk management is like sailing in stormy seas without a compass. Every serious investor needs strategies to protect their capital, minimize losses, and navigate market volatility with confidence. In this video, we'll break down essential risk management techniques from diversification and stop-loss orders to position sizing and hedging so you can invest smarter, stay disciplined, and safeguard your portfolio against unexpected market swings. 1. Understand and define your risk tolerance. The first step in effective risk management is understanding your personal risk tolerance. Risk tolerance is the level of volatility or potential loss an investor can psychologically endure without making impulsive decisions. It varies based on factors such as age, income, financial obligations, and time horizon. For example, a young professional with decades until retirement can tolerate high market fluctuations, whereas someone nearing retirement may prioritize capital preservation. Defining risk tolerance ensures your portfolio is aligned with both financial goals and emotional capacity, preventing panic-driven decisions during market downturns. 2. Assess risk capacity. Alongside risk tolerance, while risk tolerance focuses on psychology, risk capacity measures financial ability to take risks. Even if you are comfortable with high volatility, obligations like mortgages, tuition payments, or emergency reserves may limit your ability to endure significant losses. Serious investors must balance both psychological and financial considerations when determining exposure to equities, fixed income, and alternative investments. This dual assessment ensures that your strategy is both sustainable and realistic, creating a foundation for consistent long-term returns. 3. Diversify across asset classes and geographies. Diversification is a fundamental risk management tool. Spreading investments across asset classes, equities, bonds, real estate, and alternatives reduces reliance on a single market outcome. Within equities, diversifying across sectors and regions mitigates concentration risk. For instance, a global allocation protects against domestic economic downturns. Correlation between assets is key. Low or negatively correlated assets, such as stocks and government bonds, reduce overall portfolio volatility. Diversification doesn't eliminate risk entirely, but creates a more stable growth path, smoothing returns across market cycles. 4. Utilize asset allocation strategically. Strategic asset allocation aligns portfolio construction with risk tolerance, goals, and market expectations. It is the blueprint that determines what percentage of your portfolio is in equities, bonds, cash, or alternative assets. Tactical adjustments can be made for short-term market opportunities, but the long-term allocation drives performance and risk management. A properly allocated portfolio balances growth and protection, ensuring you don't overexpose yourself to market swings while capturing reasonable returns. This disciplined approach separates serious investors from those who chase short-term gains at the expense of risk exposure. 5. Employ stop losses and protective measures. Stop-loss orders are critical tools to limit downside risk. By predefining exit points for individual positions, investors protect themselves from severe market declines. Protective measures can also include option strategies like puts or collars to hedge equity exposure. These mechanisms act as insurance, capping losses without requiring constant monitoring. In volatile markets, implementing such safeguards preserves capital, allowing portfolios to recover and continue compounding over time. 6. Manage concentration. Risk. Investing too heavily in a single asset, sector, or geographic market exposes portfolios to unnecessary volatility. Concentration risk occurs when an investor's returns are overly dependent on the performance of one holding. Serious investors mitigate this by spreading capital across multiple securities and sectors, and by limiting exposure to any single investment. Even high-conviction bets should be controlled relative to overall portfolio size. Properly managing concentration risk reduces the likelihood of catastrophic losses from unexpected events affecting a single stock, industry, or country. 7. Monitor liquidity and market risk. Liquidity risk is the potential difficulty of converting assets into cash without significant loss, while market risk reflects exposure to general price movements. Investors must ensure a portion of the portfolio is liquid to meet short-term obligations and take advantage of opportunities without forced sales at unfavorable prices. Risk-aware investors balance liquid and illiquid assets, considering factors like transaction costs, market volatility, and redemption restrictions in alternative investments. Managing liquidity and market risk ensures the portfolio can endure both expected and unforeseen financial demands. 8. Plan for inflation and interest rate risks. Inflation erodes purchasing power, and interest rate changes can dramatically affect bonds, real estate, and other fixed income instruments. Serious investors protect against these risks by diversifying into assets that historically hedge inflation, such as real estate, commodities, and inflation-protected securities. Monitoring central bank policies and macroeconomic trends allows adjustments to duration exposure or allocation, reducing vulnerability to rising rates or high inflation environments. Ignoring these risks can quietly reduce wealth over decades, undermining long-term objectives. 9. Implement regular portfolio review and rebalancing. Even a well-constructed portfolio drifts over time due to differing asset class returns. Rebalancing restores original allocations, keeping risk levels aligned with objectives. For example, if equities outperform, the portfolio may become riskier than intended, necessitating a trim of overexposed assets and reinvestment into underweighted classes. Regular reviews also allow the identification of underperforming investments, potential replacements, or emerging risks. Discipline in monitoring and rebalancing ensures that risk management strategies are consistently effective. 10. Maintain emotional discipline and long-term perspective. Perhaps the most critical risk management strategy is behavioral control. Emotional reactions, panic selling during market crashes, or chasing speculative trends pose greater risk than market volatility itself. Serious investors develop and adhere to a written investment policy statement, IPS, which outlines target allocations, risk parameters, and rebalancing rules. This framework supports rational decision-making during periods of uncertainty. By maintaining patience, focusing on long-term objectives, and avoiding impulsive reactions, investors preserve capital and capture compounding returns, ensuring sustainable wealth growth. Smart investing isn't just about chasing returns. It's about protecting what you've built. By applying these risk management strategies consistently, you can reduce losses, navigate volatility, and grow your wealth with confidence. If you found this guide useful, be sure to like the video and subscribe to the channel for more insights on investing, portfolio protection, and long-term financial success. Stay informed, stay disciplined, and invest wisely.